Guys, welcome to this webinar. My name is Tim Hart. I'm one of the directors from Private Mortgages Australia. And thanks for joining us on the webinar today. We want to cover a few things. We're going to talk about private lending in general, but also give you a bit of an update on something that we've done recently, which is actually to increase our maximum loan-to-value ratios. So before I get into that, I just want to cover off what the three products are that we offer. So the first one is a first mortgage, and the rates for that anything from 1 to 2.5% per month. The reason we quote in per month is because we are a specialist short-term lender. So we can do anything from a 2-month loan, anything up to 36 months for our first mortgage type lending. But most of our loans are usually around that 4 to 6 month mark. Loan amounts anything from 100,000 up to 2 million. Second mortgages, something that no other sort of bank or a lot of lenders do, is actually second mortgage funding, whereas we're happy to sit second place to say a bank. The interest rates for that is slightly higher because it is obviously a riskier position to be in, and we'll do anything from 2 to 12 months for a second mortgage and anything up to about $1 million in loan amount. The last one we've got is a caveat second mortgage. So this is where it's still a second mortgage. However, the client might need the funding within a couple of days, and we don't have time to actually register our second mortgage, that we can come in and just settle the loan really, really quickly. And this is where someone needs money only for, say, 2 to 6 months. And because of the time aspect of it and the fact that we can't actually register our mortgage, that's why the interest rates are a little bit higher on those ones as well, at 3 to 5% per month. So that's the three products that we offer. So you may have seen in the marketplace, we've just had some exposure in the last couple of weeks. We've had a couple of write-ups. One, Your Investment Property, Australian Broker, and Mortgage Professional Australia have all done write-ups about our changes, where we've actually lifted our maximum loan-to-value ratio up to 80%. Now, we only do this for residential security, and it's only in particular suburbs. So what's the way we've able to do this is that we've actually partnered up with a company called Property Predictions, and there's a guy called John Lindeman, very, very switched on man. And what he's done for a long time now is he looks at the real basics of the market and just looks at the pure supply and demand to work out where is a suburb most likely to go for a particular period. You can see the bar chart, if you like, down the bottom here. He's got 5 different categories. So he says a suburb is either in stressed, buy, neutral, seller, or boom. So neutral, pretty self-explanatory. He thinks the suburb is not going to go anywhere. If he thinks it's a seller market, he expects the market to actually go up by anything up to 10%. And if it's in boom, he expects it to go more than 10% increase. Likewise, on the other side, if it's a buyer market, he expects it to drop by up to 10%, and a stress market more than 10% change in the value. So I've got a couple of quotes in there as well that you'll notice. We've got most lenders will generally only lend 65 to 70% LVR. And a lot of the time, they actually do this based off a forced sale valuation rather than the true value of a property, like a market value valuation. Whereas we always take the true value of security properties without any tricks in order to give the borrowers a better solution. So this is what this is all aimed at doing, is allowing us to go a little bit higher in the LVR to give your client the solution they need, maybe a little bit more money to help them with whatever solution they're looking for. So if you do have a client that is looking for that higher loan-to-value ratio, what we will do is basically run one of these reports from John Lindeman to see if that particular suburb is going to be going up in value. That allows us to be that a little bit more aggressive to go up. So it is only in selected suburbs, but just gives you a bit of an idea of how we're always sort of updating our policy to be more accommodating for more and more borrowers. So just with that in mind, in terms of LVRs, let's take a quick look at our loan-to-value ratios and what we look at. So you'll notice there's 4 different categories. So we actually base the LVRs that we do based on the Genworth financial postcode categories. So for those of you who don't know, Genworth Financial being one of the mortgage insurers in Australia, and they do obviously a lot of research into what suburbs they think are good, and a lot of it is around population levels. So category 1, for instance, is mainly anything that's sort of your 40 to 50 Ks from a major city, like a Sydney, Brisbane, Melbourne, that sort of thing. And that's where most properties are located. Category 2 is more your major regional hubs, so your major regional towns. Category 3 is regional towns, but usually smaller regional towns, might have smaller population levels. And category 4 is affectionately known in the office as whoop whoop. So a property that's in the middle of nowhere, usually much smaller population, maybe even farming or rural, where we will still lend. However, the amount we'll lend will be significantly less. Now you'll find most banks, or even a lot of banks, won't actually even lend in category 3 and 4. Usually they stick to just category 1 and 2. But that's one of the advantages of using a private lender, is it's all about flexibility and coming up with a solution for the client. The last thing I want to mention we've got here is this maximum column. So as I mentioned, private lending is all about flexibility. So we actually have discretion in our internal policy and also in our fund to go to slightly higher LVRs than we do for our target. So category 1, we've got a target of 75% being the maximum. However, as we've just discussed, we've actually got discretion to go up to 80%, depending on maybe the exit strategy and the postcode of the security property. So it allows us to have that discretion. At the end of the day, we're commercial. Okay, as long as it makes commercial sense for us to go to that higher LVR. Maybe there's some additional security property, or maybe they've sold the property. And as long as there's a good reason behind it, it allows us to go to those higher loan-to-value ratios for the client. Okay, the other thing a big question we get asked as well is, what's all the fees and costs and charges associated with a private loan, obviously other than the interest rate. And so we have an approval fee. So anything from $100,000 to $500,000, we charge a 3.5% approval fee. And included in that is a 1% that we pay to our referrers. So for us, it doesn't matter if a client comes to us directly or through a referrer, they're always going to pay the same amount. So there's no advantage from a client coming to us directly as opposed to using a referrer or a broker to come through to us. And you can see there it tiers down. So obviously the larger the loan, the lower their approval fee. The only other fees that we charge, we have an assessment fee, which is something we charge at the start of the loan, which is only $550 to $770, and it's based on the complexity of the loan. So this is just to cover our cost of doing title searches and credit checks and bankruptcy checks and all that sort of thing, even desktop valuations. It is all included in that to cover our cost of analysing the loan. Any other expenses, like if we need a valuation, which we don't always need, but that's always done at cost. And same with the legal fees, they're always done at cost. We make no margin or any profit on any valuations or legal expenses. And the other thing is, like I've mentioned, is that referral fees, we're very much channel agnostic. So it doesn't matter where that borrower comes from. It's always going to be the same amount they're going to pay as the approval fee. The other thing, with Private Mortgages Australia, we are heavily reliant on our referrers. We probably get about 90 to 95% of our business comes from referrers. So we always want to make sure we look after our referrers, and that's why we put on these webinars as well, to sort of help educate our referrers about what we do and how they can create extra revenue streams for their business and better solutions for their client by looking at private lending. So some of the other ways that we work with referrers, in addition to getting a share of the approval fee that we just went through, we allow our referrers to actually set a service fee or a mandate. So you might be getting, say, 1% of the approval fee, but you might also want to charge a $1,000 service fee. It's up to you. We just ask that you let us know when you submit the application how much you'd like to make as a service fee. So it's just allowing you to dictate how much you make from a particular loan opportunity, based, on how much effort it's going to be for you to do the loan. The other thing is that, and this is something that I don't know of any other lender in Australia that does this, is that we'll actually pay a subsequent referral fee even if the client comes to us directly. So if you send John Smith to us and he has a loan and it all goes well, he then comes back and wants another loan and comes to us directly, even though you might not be involved in that transaction, we'll actually still pay you out of the approval fee. So which is a really good, a fun thing for us to be able to call up one of our referrers and say, hey, can you just send us an invoice for say $3,000? So as long as that client hasn't gone and got another referrer, it's just a way for us to thank you for that client, because ultimately they're your client. And we want to thank you for that relationship. So it's just that ongoing relationship. We want to continue to pay you for that. The other thing we have is the Referrer Rewards program. So this is what it looks like, this table here. Basically, as you hit key milestones in terms of loan volume, we give you a bit of a bonus in terms of a gift card of choice. So this could be a gift card from Myers or Dan Murphy's or Flight Centre, wherever you want. Just let us know. The other thing that I want to point out is that these gift cards are cumulative. So let's say the first loan you write with Private Mortgages Australia is a $2 million loan, then you'll get the $1,000 gift card plus you get the $500 gift card plus the $250 gift card. So you would actually get $1,750 worth of gift cards. So it's something that can add up quite quickly, and that's just another way that we reward our referrers, to say thanks for bringing them through to us to help out your client. The other thing we have, once you hit $3 million, you enter the PMA's Platinum Playground, which means basically, provided you hit a minimum loan volume every year of $500,000, we give you an additional $500 gift card, which comes in handy, especially around Christmas time when you've got presents to buy, or maybe it's some nice bottle of red or bubbles for Christmas Day or for New Year. So that's something we send out to our referrers. So let's now go through what our settlement process is. So as soon as we get an application form in, this is our process basically from start to finish. So we either get an application form in, or because for us it's all about speed, we've actually got a one-page quick app form. And as the name suggests, it's literally a one-page form that you just give us the real high-level details of the loan opportunity, and we can do our assessment and provide you an indicative letter of offer just based on that one-page quick app. Okay, so this is just making it nice and quick and easy for our referrers to get an answer and say, yes, can you do this transaction, and roughly what's the fees and costs going to be. So when we produce an indicative letter of offer, that'll have all the fees and charges on there, what the rate will be, and also how much the assessment fee will be. So as I mentioned before, that's just the $550 to $770 that we charge, and that we then complete the balance of our due diligence and then straight to letter of offer. As soon as the letter of offer is accepted, we have our solicitors draw up the paperwork. We have specialist solicitors that specialise in legal documentation of loans, and most of the time they'll churn them out within a couple of hours up to 24 hours. So really fast turnaround. So that way we can then settle the loan as soon as we get those documentation back from the client signed. So the whole idea is this. The process has been streamlined for speed so that we can settle a loan within 1 week, 2 weeks. We're not like a bank that's going to take 4 to 6 to 8 weeks if you're lucky. The next thing I want to take you through is when we get a loan transaction in, what do we do? How do we actually qualify a deal? And so we call this our first filter. So the very first thing we look at to see if it's a deal that we can do. So the very first thing is the loan a non-coded loan? Because we can only do business loans. We can't do any consumer loans. So the way we determine that is the first thing we look at is who is the borrower. So if it's a corporate borrower, so it's like a company that's borrowing the money, it's automatically deemed to be non-coded. So it's a nice, simple, easy one. If your client has a company that's borrowing the money, great, it's non-coded. Easily done. Compare that to if it's an individual who's the borrower. if the purpose of the loan is for domestic purposes, like they want to buy their own house or go on holiday or buy a car or something like that, then it's a coded loan and we cannot fund that loan. However, if more than 50% of the funds are used for a business purpose, so they're buying into a business or something like that, then it's deemed to be non-coded. The other thing we look at is the type of security property. So if the security property is a commercial property, it's deemed to be non-coded because it's commercial in nature. Whereas if it's residential, same sort of thing, we need to look to make sure that more than 50% of the funds are being used for a business purpose. Okay, so that's the very first thing that we look at, and that just takes out quite a few of the loan opportunities sometimes if they're coded loans. The next thing we look at is the client prepared to pay at least 1% per month as an interest rate? Because that's the cheapest amount that we'll do when it comes to private lending. So we want to make sure that the client's not expecting to go and get a 5 or a 6% interest rate like they might do with a 30-year bank loan. Okay, this is very much short-term lending, and we want to make sure that their expectations are that they're going to pay at least 1% per month. The next one we look at is the postcode and LVR, or the loan to value ratio. So the table we had before that had a look at what postcode categories we'll look at and what LVRs will do. So we want to make sure that they're not trying to borrow, say, 90% on a category 4 location, a property that's in the middle of nowhere. So we want to make sure that that stacks up. Maybe they're trying to get a 75% loan on a residential property that might be, say, 10 kilometres from Melbourne CBD. Okay, great. That fits within our criteria. The next thing we look at is the referrer service fee or mandate. Basically, if you're referring us a client, we want to make sure that we know how much you want to make up front, and we make sure that's noted in the indicative letter of offer. So it's all very transparent. Everyone knows who's getting paid, and it's all set up front. The next one is exit strategy. This is probably one of the most critical things we need to know is how is the client actually going to repay the funds at the end of the period. For us, serviceability is not required. Our loans are prepaid. So if you have a client that wants money for, say, 6 months, we'll actually prepay the payments for the 6 months for them. So they'll get a lump sum up front, and then 6 months later, they pay a lump sum back to repay the loan in full. So because there's no payments along the way, we don't really look at serviceability of the loan. It's not designed to be a loan that's going to be paid monthly payments for the next 30 years like a bank loan. So that's a real benefit for a lot of clients that perhaps can't prove serviceability, or they don't want the hassle of making payments on such a short-term loan as well. So what we're more focused on is how is the client going to pay this loan back, whether it be the refinance of a property, it might be the sale of a property. They're probably the most common ones that we see. The next one is, why can't the client get bank finance? This is not something that a lot of private lenders might ask, but for us, if the client can get bank funding, don't use us. Okay, we're always going to be more expensive than a bank, and we're not trying to compete against the banks in that, but we will be able to compete from timing and also flexibility in terms of when we will and won't lend a client some funds. So we just want to make sure that we're setting the expectations up front and looking at the reasons why they can't get funding, so that make sure we can tackle that issue right up front. The last one is, when does the client need to settle? We want to make sure that we're working towards a common goal, that we're going to meet the expectations of the client. So if they need to settle in 7 days time or whatever it might be, we know that up front, and that we're all working forward, and so we can come up with the funds on time for your client. So let's just go through a bit of a case study of a transaction we did. The scenario was we had a development site in Altona North, and this is for a 3 townhouse development. So those of you who don't know Melbourne, Altona North is just in the western suburbs, probably about sort of 5 to 10k from CBD, so great location. And they were about 90% of the way complete. They were basically trying to self-fund their development, and they ran out of money. There was no bank finance was available because they only had 2 pre-sales there. So that's that was sort of their exit strategy, is they had the 2 pre-sales to be able to pay us out. So some of the numbers around this, the valuation, the as-is valuation once the townhouses were complete was 1.95 million. They already had a first mortgage in place of $520,000. They had a build contract of $650,000, of which they'd already self-funded $250,000. So what they had a shortfall to complete the construction of $400,000, and that was the issue that they came to us with. And they only needed the money for 2 months. So in 2 months, that's how long they needed to basically complete the build. So what we did is we ran our first filter. So the first filter is the loan non-coded. Yes, it was a company borrower. Is the client prepared to pay more than 1% a month? Yes, the borrower was happy to pay 1.9% per month because it was a second mortgage facility. The postcode was category 1 because it was very close to Melbourne, and the loan to value ratio was less than 65%, so it fit within our loan to value ratio matrix. The referral fee was $2,871 on this one. The exit strategy was the sale of the units. So that's a very, very strong exit strategy. If we can see, we've got some unconditional contracts there. They couldn't get bank funding for a number of reasons. So one, they were self-employed and didn't have financials. They also had no experience. So this was their first development. So as a lot of you are aware, the banks are making it very, very hard for development funding at the moment. And to the point where if the client hasn't done a similar development, like if it's a 3 townhouse development, unless the client's done a 3 townhouse development before, they're not going to give them the funding for it. The other one was the time frame, that they needed the funding very, very quickly because the builder was owed $330,000, and unless they got paid, they were going to stop work. So they needed money very, very quickly and for a short period of time. Most banks do not like completion finance because they don't like lending on incomplete security. They like to lend at the start before the project's finished, or they like to refinance it once the property's all complete. But it's a real grey area when the project is sort of incomplete. So there was a myriad of reasons why they couldn't get bank funding, and that's why we came in and sort of helped them out. So when did they need to settle? Basically as soon as possible, and this is the scenario we see a lot of the time, is just as quickly as possible, so that they could pay the builder, finish off the project, get the pre-sales done. So the solution that we gave them was we gave them a $435,000 second mortgage, and the interest rate was 1.9%. The term was just 2 months. We also provided them extensions. So all of our loans come with extensions, because we live in the real world and we know that things don't always go according to plan. So we give the clients the ability to extend the facility 1 month at a time. So they can just pay 1 month's interest and extend the facility if something's gone wrong. And the exit strategy was the sale of the townhouses. So this really worked for the client, and the reason it worked is because the cost of this loan was not a lot compared to how much they're actually going to make from the project. And one of the biggest things we get, I suppose, feedback we get, and especially from referrers who have never done private lending, is they really get hung up on the interest rates. And even the clients who have never borrowed, they think, oh my God, 1.9% per month, that's such a high interest rate, there's no way I can make this work. And so the way we educate our referrers, and I suppose we like you to educate your clients as well, is it's about the total cost of the loan, not the interest rate. Okay, because if we look at the total cost of the loan, that includes the interest rate. Okay, so in this example, the interest for the 2 months was $16,530. The approval fee was just over 15 grand, and the legal fee was $2,735. So the total cost to the client was $34,471 for this facility. Now that's really important to look at that, because if you just looked at the interest rate, that's actually less than half of the cost of the loan. We actually just recently did a comparison. Someone was looking for quite a large construction facility, and we quoted them, I think it was around 17% interest, and they had another offer from another lender that was at 9% per annum. But once you added in that, they had a management fee of 4% a month, they had exit fees. The long and short of it is their loan was actually more expensive than ours by about $100,000, even though our interest rate was more expensive. Okay, so this is why we stress to look at the total cost of the loan. It's the best way to be able to compare one loan to another. Because you might have the interest might be $16,000, but if the approval fee was $100,000, you can see it doesn't quite make sense. So just a really big thing, and this is where we see a lot of first-time brokers or referrers who get into private lending, they fall over, is they focus on the interest rate and they pass that on to the client. That's their focus, and I suppose that's just in traditional banking land, that's what most people sort of focus on, is just how can I get the cheapest interest rate. So we just like to look at that more, the total cost. So once we've got the total cost of the loan, we can then compare that to how much is the client going to make, or in some cases, how much is the client going to lose if they don't get this loan. So if we have a bit of a feasibility of this particular development, the gross realization value was at 1.95 million, and the cost, they purchased the land for 650. They had some stamp duty costs and build costs, and we've estimated all the other costs, being real estate agent fees, council contributions, and some holding costs, at around about $115,000. All up, this client, by doing this transaction, is going to make a profit of $500,000. So the way to look at private lending is almost like a joint venture partner. Does it make business sense to give away 7% of your profit, being the $34,000, to get the deal done? So for me, absolutely. I would pay $34,000 to make $500,000 every day of the week. Whereas if you can see, if the cost of the loan was $600,000, then of course the client wouldn't do it. So if you looked at this, to get the money, to get the $400,000 they needed, if they got it from an equity partner, an equity partner is probably going to want a lot more than 7% of the profits. They're probably going to want half the profits or something like that. So that's where you can start to see that private lending, when used correctly, is actually incredibly cheap, compared to what other options there are out there to do it. So just to have a look at some of the other things that we specialize in. Obviously, we went through development funding there and completion finance. It is something we see a lot of at the moment, especially because the banks are making it so hard to get funding for developments. But the main one we do is urgent funding, where a client just simply can't wait for the bank to get the loan done. So where we can do loans, we've done stuff within a couple of days before, and first and second mortgages, 1 to 2 weeks is a very, very achievable turnaround time for us. The other big one is asset lending. So where a client can't prove serviceability, they just want someone to lend them purely on the asset that they're putting up as security. Other one, we get ATO debts. So most banks will not lend to a client unless they've got a clean ATO portal. So all their debt is, their taxes are up to date. So sometimes we can come in, provide them a short-term facility to pay out the ATO debt. Once they've paid that out, they've now got a clear ATO portal. They can then maybe go and get a refinance and move on from the loan. Another one we do is refinancing existing caveat loans. So we've seen caveat loans, we saw one the other day that was in default, and the client was paying 15% a month in default interest rate on a caveat loan, whereas we could come in and refinance them to a much, much lower rate. I think it was about 2.5% per month we did for that client. So just helping them get out of those really high loans that they've got. Something else we do is valuation, not contract. So we're happy to lend on the higher of valuation and contract price, whereas obviously most banks, all banks, are only going to lend on the lower of valuation and contract. So same again, we're property investors. We live in the real world. We understand that you can buy a property under market value and that you can add value to a site. And we're happy to lend you on the true value of the site, not just what they bought it for. So that alone can really help with the LVRs. We might do, say, a 75% LVR, but because it's on the true value of the property, that might be 100% of what they bought it for, or even more. We did one the other day. It was about 110% LVR on what they bought it for, but it was only a 70% LVR on the valuation, so that allowed us to do that loan. Otherwise, your client might be paying out a business partner, or they might have an urgent business opportunity they want to take advantage of. The last one I want to mention is credit impaired. Okay, because we're not designed to be here where the client makes payments for for the next 30 years. Credit is not so much of an issue for us because the payments are prepaid. The only time that credit might be an issue for us is if the client's exit strategy is to refinance. Okay, we want to make sure that we're setting the client up for success, that if their exit strategy is refinance, we want to make sure that the bank who's refinancing them isn't going to have an issue with whatever credit issues they have. Okay, two last things, or two last slides I want to cover here is just sort of a borrower beware. And just to let you know some of the other sort of tricks that some other private lenders play in the marketplace and just how to avoid them. Some things we see is lenders quoting from rates. So they might have interest rates from 1%, but there's no upper edge of the envelope when it comes to what the rate could come back at. So you might submit an application and interest rate from 1%, and then the interest rate on the offer might come back. It might be 5% per month or 6% per month. You never know what it's actually going to come back at. Compare that to Private Mortgages Australia, where we have a fixed rate. So our first mortgages will be between 1% and 2.5% per month. It's not going to suddenly come back at 3, 4, 5% per month. Another thing we see is big upfront fees before the final offer. We saw one the other day. It was that the client had to pay $18,000 before they even saw the final offer. And if the loan didn't proceed for whatever reason, then that client lost the $18,000. So we just don't like to see that. We just see a lot of clients who get burnt in that way, where they've spent a lot of money and they didn't get anything for it. Whereas us, we very much like to, it's only $550 to $770 up front before they'll get the final offer. The only other cost that they might pay is maybe for a valuation, which we would do at cost. Another one we see in the marketplace is people saying they can do loans in 24 hours. This is something, or a tactic, a lot of lenders use to get borrowers into their system. Very, very few lenders in the marketplace can do a 24-hour loan. To go from start to finish, and including legal documentation, drawdown, it's a very, very long process, and there's a lot to do in 24 hours. And for Private Mortgages Australia, we can't do 24-hour loans, and we don't proclaim to do. However, we have done stuff within a couple of days before. So just be wary of someone that says they can do a loan within 24 hours. My question would be, how many loans have you done in 24 hours? The answer is probably going to be one or none. And the idea is that they'll get you into the system, and 24 hours later it will be, we just need another 24 hours or another 24 hours. And by then the client is then committed into the process. And there might even be cancellation fees if they then withdraw from the loan. Another one we see is very expensive valuations for forced sale. So first thing is they will charge more for the valuation than it costs them to get it done from the valuer. So they're making a profit on the valuation. And the other thing is the purpose of that valuation is for forced sale. So it's not for market value purposes or mortgagee purposes. They use it for forced sale, which is basically telling the valuer, please value the property really, really low, and lo and behold, it comes in really low, and then maybe they don't do the deal. So just something to keep in mind is what's the purpose of that, the valuation. The other thing we see is cancellation fees. So where if the client doesn't proceed with the loan, or even if the lender doesn't proceed with the loan, there's a cancellation fee, and that the lender will then caveat the borrower's properties and pretty much hold them to ransom until they get paid their cancellation fee. So we have some real issues with that, especially if the client hasn't even seen the final offer, that they have to pay all these fees and charges. So where I suppose PMA and why we came into this industry is coming from a point of view of we want to do cleaner loans and better results. That's our tagline. And the way we do that is basically doing the opposite of everything that we've just gone through, where we'll have low upfront assessment fees. We have no charging clauses in our indicative letter of offer. So if your client agrees to an indicative letter of offer and then for whatever reason the loan doesn't proceed or they don't want to go through with the loan, there's nothing that they need to pay. Okay, there's no cancellation fees. The other thing, we do valuations are done at cost. We also do them for a reasonable value. Any legal fees are done at cost. We've got capped interest rate ranges, so you know exactly what the interest rate is going to be, what range it's going to be in. We also rebate any unused interest on extension payments. So your client might have a prepaid loan for 6 months. At the end of the 6 months, they say, "Oh, look, we just need a couple more weeks to line up the settlement," and so they'll pay 1 month's interest, and we'll extend the loan for 1 month. However, when they repay the loan 2 weeks later, we'll actually rebate them the 2 weeks that they didn't use. Okay, so it's just rebating the interest that they didn't use, which we see is a fair way to do it. The other thing we've got is custom-built software for faster processing time. So we've spent the last probably 3 years and a lot of money building our own software so that we can actually process loan applications faster than other people in the marketplace, because that's what private lending is all about. It's that fast processing time. So that's what we're very proud of. We've got our own proprietary software for processing deals. The other thing we have is a very high level of repeat customers. Okay, and this is where we know we've done the right thing, when we've got a client that's had a good experience and they come back to us again and again and again. And that's what we want, not only with our borrowers but also our referrers as well. For us, it's all about a win-win approach to lending. Okay, we're going to be here for the next 10, 20, 30 years to come. So we want to be known as a lender that has a win-win approach to lending, and that we have borrowers and referrers that have positive experiences with us. So that's all about the PMA way. Now, if you do have questions, please, as I said, you can type them into the question box. Otherwise, we will sort of finish it up there. If you do have a specific loan scenario that you want to run past us, we've got the contact details there of Shanta Loba, who's our Senior Relationship Manager. We've got a direct number and email there. The other thing we've got is our website. So on our website, Private Mortgages Australia, we've also got a resources tab or resources section. There's a heap of information in there and resources for our referrers to help you understand private lending, but also how we do it. The other thing we're going to send through to those that have registered is a certificate for your CPD points, and also a copy of the slides. And we've also got 3 case studies that we'll send out to you as well. So just so you can get a bit of a feel for the types of lending and the types of deals that we do. So guys, thank you very much for attending. We'll get that information out to you shortly. But look, we look forward to hearing from you and helping out some of you and your clients. So guys, have a good day, and we'll talk to you soon. Bye.